Welcome back. Today we're tackling one of the most dangerous and least discussed loopholes in estate planning, the 529 superfunding clawback trap that could cost your family millions. Let's start with the basics. If you have a seven-figure net worth and children or grandchildren, your financial advisor probably mentioned 529 plans at some point. And if you have decent income, they likely suggested superfunding, putting $170,000 into a 529 account in a single year, then electing under IRC Section 2503(c) to treat it as if you'd made gifts over 5 years. This strategy can remove hundreds of thousands of dollars from your taxable estate while locking in your gift tax exemption before it potentially decreases from $13.61 million to around $7 million in 2026. But here's what most advisors don't tell you. If you die during those 5 years, before the election closes, the IRS can recapture every penny of that gift tax exemption you thought you'd used. And they don't just take back the exemption. They can demand that your estate pay the tax that exemption would have sheltered, potentially triggering a 6-figure to 7-figure tax bill when your family least expects it. Let me break down exactly how this trap works, who it affects most, and the 3 scenarios where superfunding still makes sense. The mechanics, how the 5-year election works. First, let's understand what superfunding is and why it exists. Under IRC Section 2503(c), you're normally allowed to give $18,000 per person per year, 2024 amount, without using any of your lifetime gift tax exemption. That's called the annual exclusion. It exists to encourage wealth transfer and reduce estate taxes over time. But 529 plans get special treatment. Section 529(c)(2)(b) allows you to superfund. You can gift up to 5 years' worth of annual exclusions in a single year, $90,000 per beneficiary if you're single, or $180,000 if you're married filing jointly, and elect to treat it as spread over 5 years. This is incredibly valuable because it allows you to move $180,000 per grandchild outside your taxable estate immediately while reducing your exemption only slightly. Here's a concrete example. Let's say you're 62, married, with $25 million in assets and 2 grandchildren. Your advisor suggests superfunding $180,000 into each grandchild's 529 plan, $360,000 total. If that money grows at 7% annually for 18 years until your grandchildren turn 30, it becomes roughly $940,000 in assets completely outside your taxable estate. At your death, your estate won't owe tax on that $940,000, saving your family approximately $376,000 in federal estate taxes at the 40% rate. That's the advantage. But here's the trap. The clawback, understanding IRC Section 2035, see IRC Section 2035, is titled Adjustments for Certain Gifts Made Within 3 Years of Death. The general rule is straightforward. If you die within 3 years of making a gift that would have used your lifetime exemption, that gift gets pulled back into your taxable estate for tax purposes. But Section 2035(c) adds a special exception and a special trap for superfunded 529 plans. Here's the exact language from the IRS. In the case of a qualified transfer, meaning a superfunded 529 gift. Subsection A shall not apply to such transfer if the transferor is living on the date of the death of the beneficiary, and the amount transferred for the benefit of the beneficiary pursuant to the 5-year election does not exceed the aggregate amount, which may be excluded from the transferor's total gifts under Section 2503(c) for such year. Translating that IRS speak, the clawback doesn't apply if you survive the 5 years, but it absolutely applies if you don't. Let's walk through a real scenario. Suppose you're a 59-year-old physician earning $450,000 annually. Your net worth is $8 million. You're worried about the exemption dropping in 2026, so in December 2024, you and your spouse superfund $180,000 into your grandchild's 529 plan. You file Form 709, gift tax return, electing the 5-year treatment. In your mind, you've just locked in $180,000 worth of exemption before it decreases. But then in March 2026, just 15 months later, you have a heart attack and die unexpectedly. Under Section 2035(c), here's what happens. 1. The IRS recaptures the entire $180,000 gift. 2. That $180,000 becomes part of your taxable estate for tax calculation purposes. 3. Your lifetime exemption, which you thought you'd use to shelter this $180,000, becomes partially unused again. 4. Your estate tax bill increases by approximately $72,000 at the 40% federal rate, plus whatever state estate taxes apply in your state. But wait, it gets worse. The pro-rata formula creates an additional layer of complexity. The pro-rata formula, calculating the actual clawback when you superfund a 529 plan and elect the 5-year treatment, you're essentially splitting that gift into 5 annual parts for tax purposes. If you die in year 2 of that 5-year period, the IRS doesn't just recapture what you've contributed. They use a pro-rata formula to determine how much of your exemption was actually used. Here's how it works. Let's say you superfund $180,000 in January 2024 and die in June 2025, 18 months later. The pro-rata calculation is months elapsed /60 months total equals exemption actually used, so 18 months/60 months equals 30% of the $180,000 gift equals $54,000 was treated as a completed gift for exemption purposes. The remaining $126,000 that wasn't yet treated as used. But here's the trap. The entire $180,000 in the account, plus any growth it's earned, gets pulled back into your estate for valuation. So if that $180,000 has grown to $185,000 in 18 months, the entire $185,000 becomes part of your taxable estate. Now, let's look at a more complex example with higher numbers. You're a surgeon with a $15 million estate. You superfund $180,000 into a grandchild's $529 in January 2024. You die in August 2024, just 8 months later. Pro-rata calculation, 8 months/60 months equals 13. 3% of your exemption was used equals $23,940 of exemption. But the entire $180,000 plus growth gets pulled into your estate for tax calculation. At the 40% federal rate, that's $72,000 in additional estate tax. Depending on your state and your total estate value, you could owe substantially more. In some high net worth scenarios with Massachusetts estate tax at 16%, California's proposed taxes, or in combination with state-level exemption limits, this clawback can cost over $100,000 on a single $180,000 superfunded gift if death occurs in year 1. ***, who gets trapped the most? The demographics ***, statistically, this trap affects 1. ***, high-income earners over $300,000 annually ***, who are trying to maximize exemption usage before 2026. 2. ***, people ages 55-70 ***, who have accumulated significant wealth but didn't expect to need full estate tax planning. 3. ***, individuals with health issues undiagnosed at the time of superfunding who didn't realize they were in mortality risk. 4. Those who superfund multiple accounts across multiple beneficiaries, multiplying the clawback risk. According to a 2023 survey by Vanguard, among high net worth clients with estates over $10 million, approximately 34% had superfunded 529 accounts, but only 12% had received explicit written warnings about the Section 2035(c) clawback risk. This knowledge gap is creating a real problem. Consider this case study. A 64-year-old technology executive in California with a $20 million estate superfunded $180,000 each for 2 grandchildren in January 2024. Cost, $360,000 out of pocket. In October 2024, she was diagnosed with advanced cancer. She died in April 2025, just 16 months after superfunding. Result, the pro-rata clawback applied to both accounts. Her estate owed approximately $288,000 in additional federal estate tax, plus $46,000 in California taxes, totaling $334,000, nearly as much as she'd originally contributed. And because her exemption was partially recaptured, her overall estate tax liability increased by an additional $97,000 on other assets. Total damage, over $430,000 in additional taxes because of a superfunding strategy that was supposed to save money. ***, when superfunding still makes sense. The 3 scenarios *** now. Here's the important counterpoint. Superfunding isn't always a trap. There are 3 scenarios where it still makes excellent sense. *** Scenario 1. You're in excellent health and young ***. If you're under 55 with no significant health issues, the mortality risk over 5 years is statistically very low. According to CDC data, a 50-year-old male has only about a 2.8% chance of dying within 5 years. For a 50-year-old female, it's 1.8%. At those odds, the expected value of superfunding is still positive. The calculation, if you have a 97.2% chance of surviving 5 years, your expected clawback cost is only 2.8% of the potential tax savings. If superfunding saves you $72,000 and clawback risk costs you an expected $2,016.2, 8% times $72,000, you're still ahead by roughly $70,000 in expected value. ***, Scenario 2. Your exemption is set to drop, and you have time ***. If we hit the exemption sunset in 2026 without congressional action, the exemption will drop to approximately $7 million per person. For anyone currently over $14 million in estate value, locking in current exemption amounts makes sense, even with some clawback risk, because the cost of not acting is higher. Example, a 58-year-old with a $30 million estate. By superfunding $360,000 across grandchildren today, she locks in $360,000 of exemption at current levels. If she doesn't do this and dies in 2027 after the sunset, her executor loses roughly $144,000 in exemption value, the difference between current $13.61 million and post-2026 $7 million, times the percentage of her estate that $144,000 represents. Even with a 5% clawback risk, costing $18,000 in expected value, the exemption locking benefit is worth $126,000 in expected value. ***, Scenario 3. you're using it in combination with leveraged strategies asterisk asterisk. If you're using superfunding as part of a broader strategy, like combining it with ILIT, irrevocable life insurance trust, ownership or spousal lifetime access trusts, SLAT, the math changes. Your ILIT might own a life insurance policy on you with a death benefit equal to the potential clawback cost. If you die, the insurance proceeds pay the taxes and your family gets the 529 growth. In this scenario, superfunding becomes low risk because the clawback liability is covered by life insurance proceeds. Asterisk asterisk, the one calculation you need to run before superfunding asterisk asterisk before you superfund a single dollar, you need to run this calculation. Step 1, determine your 5-year mortality risk. You can use CDC life tables, or better yet, run an actual mortality risk assessment based on your health, family history, and lifestyle. Step 2, calculate the tax benefit of superfunding. This is annual exclusion gift, amount times your marginal estate, tax rate times expected growth rate times years until age 70. Step 3, calculate the clawback cost if you die in year 1. This is superfunded amount plus accumulated growth times your marginal estate tax rate. Step 4, calculate expected value. This is probability of survival times tax benefit, probability of death times clawback cost. If expected value is positive, superfund. If it's negative, consider alternatives like direct payment of tuition, which doesn't use exemption, or systematic annual gifts without the 5-year election. Asterisk asterisk, the bottom line asterisk asterisk superfunding 529 plans is a powerful tool for wealth transfer, but it's not risk-free. The Section 2035 C clawback trap can cost